Today, we will talk about follow-on offerings, FPO. A follow-on offering is an issuance of stock shares following a company's initial public offering, IPO. There are two types of follow-on offerings, diluted and non-diluted. A diluted follow-on offering results in the company issuing new shares after the IPO, which causes the lowering of a company's earnings per share, EPS. On the other hand, during a non-diluted follow-on offering, shares coming into the market are already existing, and the EPS remains unchanged. Any time a company plans to offer additional shares, it must register the FPO offering and provide a prospectus to regulators. The pricing of a follow-on offering is market-driven. Since the stock is already publicly traded, investors have a chance to value the company before buying. The price of follow-on shares is usually at a discount to the current, closing market price. Companies perform follow-on offerings for a wide variety of reasons. Some companies may also conduct follow-on offerings in order to raise capital to refinance debt during times of low interest rates. Investors should be cognizant of the reasons that a company has for a follow-on offering before putting their money into it. Diluted follow-on offerings happen when a company issues additional shares to raise funding and offer those shares to the public market. As the number of shares increases, the earnings per share decreases. The funds raised during an FPO are most frequently allocated to reduce debt or change a company's capital structure. The infusion of cash is good for the long-term outlook of the company, and thus, it is also good for its shares. Non-diluted follow-on offerings happen when holders of existing, privately held shares bring previously issued shares to the public market for sale. Cash proceeds from non-diluted sales go directly to the shareholders placing the stock into the open market. In many cases, these shareholders are company founders, members of the board of directors, or pre-IPO investors. Since no new shares are issued, the company's EPS remains unchanged. Non-diluted follow-on offerings are also called secondary market offerings. A well-publicized follow-on offering was that of Alphabet Incorporated subsidiary Google, which conducted a follow-on offering in 2005. In early 2022, AFC Gamma, a commercial real estate company that makes loans to companies in the cannabis industry, announced that it would be conducting a follow-on offering. The company estimates gross proceeds from the sale to be approximately $61.5 million. The proceeds from the sale of additional common stock will be to fund loans made to companies in the industry and for working capital needs. Here are three key takeaways. 1. A follow-on offering, FPO, is an offering of shares after an initial public offering, IPO. 2. Raising capital to finance debt or making growth acquisitions are some of the reasons that companies undertake follow-on offerings, FPOs. 3. Diluted follow-on offerings, FPOs, result in lower earnings per share, EPS, because the number of shares in circulation increases, while non-diluted follow-on offerings, FPOs, result in an unchanged EPS because it involves bringing existing shares to the market. Hope this would help. Thanks for watching.